I'm going to kick things off by having a look at what's been happening in the markets recently and what might happen next. Hopefully, set the tone for tonight's discussion. There's just a quick disclaimer for my presentation as well on your screen. If you just read through and essentially, please, if you're unsure about anything with investments, do seek qualified financial advice. And the rest there. So thank you very much for your patience, and let's get on the show. So, I mean, the past 3 years have been quite wild, really, for investors. You've seen so much happen in terms of health events, political changes, economics. We've had so much going on. I mean, and it's quite interesting. When I was sort of running this chart, which shows that actually the last 5 years, it does show that if you were invested just before COVID struck and just sat tight, sat patient, in many investments you would now have made some money. I mean, the graphic in front of you shows the MSCI All Country World Index. I mean, that's a sort of a benchmark for global equities. And it just shows that, whilst we have so many different things going on, long-term investing can work, based on historical performance. And we certainly hope it does in the future as well. So just to give you a bit of context, I'm going to go through each of these sort of last 3 years, because I think it's really important to understand all the different dynamics and how that sort of led to where we are today. So in 2020, obviously we had COVID. February, March, that time we saw a big crash in the stock market. Very upsetting to lots of people, obviously, given what was going on, unfortunately, around the world as well. Lots of people getting ill from the pandemic. What happened was in March, the Federal Reserve said it would try and do anything it would take to try and sort of keep the economy on track. And of course, that led to some quite interesting changes for central bank policy. Investors took this as a signal to say, it's fine, everything will be better in the future. So we saw this big rally, particularly with US stocks. And of course, later in the year, in November time, we had a selection of pharmaceutical companies saying, yeah, we think we've done it, we've cracked it with a vaccine as well. So it's quite remarkable when you have a global pandemic and you actually end the year in positive territory for many parts of the world. The UK was a bit of a laggard here, but this year it's finally reached new record highs. But of course, as the world started to reopen, we had these big problems with supply chains. So companies were finding they couldn't get hold of everything that they wanted. But what was moving around the world, it was costing considerably more to do so. And of course, that pushed up all their costs. And that led to companies saying, well, I'm sorry, we're going to have to pass on some of these costs to customers through higher prices. So this sort of supply chain issue led to the start of what was quite considerable increase in inflation. Of course, the next thing to think about was what happens when you have rapid inflation. Well, the natural thing is central banks start to push up interest rates. So you saw, at the end of the year, there was a quite incredible shift in the mindset of investors. So suddenly we saw what was a 10+ year equity bull run kind of hit its peak for this part of the cycle. And you can see on your screen the NASDAQ Composite Index. This is kind of the big tech companies in the US as a good representation. Just hit its peak, and of course in 2022 you can see there, it really it fell very hard. And so we started 2022 with expectations for higher interest rates, higher inflation. What made things a lot worse was the Ukraine war. Russia invading Ukraine put the pressure on inflation. And so we saw this rapid increase in interest rates. Natural thing was growth stocks in particular were badly affected by this because of the way that they do the calculations for future cash flows and discount them back to today. It meant that some of these companies that have been stock market winners for many years were no longer attractive. Investors were less willing to pay high multiples of earnings to own these kind of stocks. And so we saw this shift from growth companies going out of favor and value stocks coming into favor, offering sort of the jam today. Towards the end of the year, we had 6 weeks of chaos with the UK government. That sort of sorted itself out fairly quickly, and we saw a big rally in some of the stuff that had been left behind. So things that caught my eye were like small caps in particular, did very well in the last sort of few months of the year. So we start 2023 in a position where investors are thinking, okay, well, we've had all these interest rate hikes. Hopefully there's signs of inflation starting to ease. Does this mean that interest rates are going to stop going up? Does this mean inflation is going to start falling? And so then January was very good for the stock markets around the world. Investors were just sort of thinking, okay, we're finally at this turning point after some difficult year and a bit. And along came the banking crisis, and this sort of knocked investor sentiment, and then sort of led to central banks being a bit more aware of, are there other things to consider beyond what's been on their agenda? And of course, everyone's asking, is the financial system safe? The message so far is yes, it's all fine, but there are some knock-on effects of what's been happening in the banking crisis, and I'll cover those in a second in my later in the inflation in my presentation. One thing is, seems to be the consensus view now is that we might have maybe one more round of interest rate hikes, but we could be near the top. And so you've seen stocks continue to sort of trickle up this year despite this banking crisis, and it sort of presents this situation where investors seem to be very confident despite uncertain economic backdrop. And so one has to wonder, is there too much complacency in the market? Let's just take a look at where we are now. So in the first quarter of this year, the NASDAQ index was up 15%. To think that last year it had a pretty miserable time, so this is bouncing back. It seems to me that investors are quite willing once again to own tech stocks, particularly ones that make money. The ones that still slightly out of favor are these unprofitable ones, but the large profitable tech companies are coming back in favor, and that's helping to drive the NASDAQ. Now, Europe with pretty miserable, continental Europe last year, and of course you're seeing France and Germany bounce back. Japan's had quite an interesting time because this has got very low rates there, a very small amount of inflation, but I just think that investors are looking at this place and thinking, well, this situation has been like that for quite a long time, yet these companies are still able to make good money. Lots of companies are sitting on very large amounts of cash, and shareholder returns, not been bad. So 8% from the Nikkei is quite interesting movement. And I think investors perhaps are looking at different parts of the world and looking to diversify their portfolio into areas that have different dynamics. And Japan certainly has that versus some of the other parts of the world. Of course, the FTSE 100 and the Hang Seng are, they're laggards, but 3% in a quarter is not to be sniffed at. I think the issue here is that both of them have been exposed to financial sector quite a lot. Of course, people worried about banks, and then worried about companies like life insurers that might have sitting on sort of losses with their bond portfolio if they were, but that's only an issue if they were to sort of liquidate them at the moment. Of course, the oil prices come off quite a bit versus, say 6 months ago. So, and the FTSE 100 is heavily exposed to energy companies. So you can get a sort of a sense of why we've seen these movements. So if you sort of take a step back and say, how does that compare to longer term performance? Well, on a 12-month basis to the end of March, FTSE 100 has done relatively better than lots of other parts of the world. But if you look at those longer term figures versus the US, it's not a patch on what you might have got from investing, say, in the S&P 500 index. But the UK stock market, whilst it's got 3% for the FTSE 100 in the first quarter this year, there are some stocks in there that have achieved really strong returns in just those first 3 months of 2023. So you can see on your screen, here's the top 10. So Rolls-Royce, best performer, 61% in 3 months. And this is all to do with turnaround efforts. It's got a new chief executive. he started to hire what seems to be all of his mates from BP. They're all coming in to join him. He's putting together a proven team, and this is quite interesting because quite often when you get a new CEO, they won't like to criticize what's gone on. They're just saying, here's the things I'm really excited about working on. But this guy now, the new CEO of Rolls-Royce, is he's not mincing his words. He's basically saying, he was quoted in the papers calling it the whole company a burning platform. So he's sort of laying out, here are the challenges, this is what we're going to do. And the stock market seems like, finally we're buying into this story. So it's had an incredible time. JD Sports is up 40%. Didn't do that well towards the tail end of last year on the stock market, but it's come out with some fairly resilient trading updates. I also had an update about longer term strategy, and investors clearly buying into that story as well. Now names like Flutter and CRH are worth pointing out. Both of them have done incredibly well because investors are betting that they're going to be moving their primary stock listings to the US. And in doing so, there's a good chance they might trade on much higher valuations. So CRH has said this is the plan, and it's gone to, at the moment, it's going to around investors and sort of shareholders and saying, are you okay? You're on board for this? Most of our business is done in America. It just makes sense to be there. And kind of what it's saying is, that, if it had a more highly rated share price, this, its implications of saying this, it could do acquisitions using this equity and get good deals there. Flutter's the same. It's kind of sort of hinting, it's thinking about this a lot, and it's going to. I think the chances look very high that it's going to sort of switch its listing. Of course, what that means is it's going to disappear from the FTSE 100 if they were to do so. So if you look at some of the worst performing stocks there, you've got Fresnillo, Anglo American, Glencore. Now these are all mining companies, and this is linked to investor concerns about the sort of global economic outlook. Now, whilst China reopening story, you might have thought that would benefit miners, the focus is very much on consumer consumption. But actually this morning we had the latest figures, GDP figures from China, and they were better than expected. Of course, now the miners are starting to tick up, potentially thinking, well, if the country's doing better than expected, will that lead to greater commodities demand? Some of the other names like British American Tobacco and Imperial Brands, they were 2022 winners. These are value stocks, very much in fashion, but I sort of sense that the market's sort of shifting a bit. Investors are looking a bit more at these growth stocks again, and perhaps they're just taking profits in some things that have done well. I think certainly that's the case with Pearson and Beasley, coming off the back of quite a good year last year. If you look at the US, best performing NASDAQ 100 stocks in the first quarter of 2023 include Nvidia, up 87%. This is very much linked to the craze of artificial intelligence. So the hot topic in January was ChatGPT, this chatbot, artificial intelligence that was going to change the way that the world works, the way that we do business, or the way people interact with search engines and so on. Now, Nvidia's technology is a key component in artificial intelligence systems. So there's been a lot of excitement there. Meta Platforms, the owner of Facebook, up 73%. Now, this is quite an interesting story where one of the key catalysts for the share price is the company saying we're going to cut a lot of jobs. And you'd think that a company says it's going to cut a lot of jobs, isn't that a sign that they're in trouble? But I think what happened here is that quite a lot of companies, particularly in the technology sector, saw during the pandemic that they were seeing really strong demand. And so they hired lots more people. And now it's got the realization they don't actually need all these people. So they're cutting back their cost base. And so, yes, I mean, that's actually sort of a key driver for quite a lot of the US tech stocks that we've seen. And some of the worst performers, things like Sirius, they've not had disappointing sort of commentary on outlook. Moderna, I think it's got a bit of a sort of an identity crisis. People look at it as being a COVID vaccine maker, but really, where's it going to go next? It had some an update fairly recently on its flu vaccine, which was not particularly sort of enthusiastic. And so, investors sort of looking at these names and thinking, okay, well, maybe I don't want to hang around. I want to sort of switch to perhaps things that may have done pretty badly last year, but they've got reason to be a bit more optimistic this year. So some of the popular funds are worth looking at, and I think that there would probably be quite a few people who are watching this webinar thinking, well, I've got a few of those in my portfolio. Names like Lindsell Train UK Equity, well, had a pretty good year, last 12 months, last 6 months, very good. So what obviously here is riding off the back of UK stocks coming back into fashion. Fundsmith Equity had a terrible 2022. Lots of people owning that fund were thinking, well, I've made lots of money year after year, but unfortunately, like I was mentioning earlier, growth stocks in particular saw a big derating, and Fundsmith was particularly caught up in that. But if you look at the last 6 months, you can see a big big recovery there. 10% Blue Whale growth, same thing, 11% recovery there. And Vanguard Life Strategy, 80%, very popular fund amongst people who want sort of a simple solution to have one product that will give an exposure to equities and bonds. And I think the bond component won't have done very well last year. And of course now, if you look at, you compare that to the MSCI All Country World Index, it's showing the equity component is helping to drive the recovery there. Capital preservation funds have been on people's radar for, I guess since COVID began in 2020, the pandemic began. But one thing that caught my eye was, 2022 tested the patience of many investors, and capital preservation funds are designed to protect investors' wealth, particularly through choppy times. But if you look at those performance figures, apart from Ruffer, the other two names that perhaps are sort of the leaders in the pack, well known for being capital preservation style, personal assets and capital gearing, they didn't do as well. And I think what the problem here is down to the bond exposure. Because bonds had a terrible time, and of course we've got Reese who can talk about the bonds in his presentation a bit later. Now Ruffer is slightly different here. It attributed its success, or rather, it managed to preserve investors' wealth from interest rate hedges. It also did some put options on sort of crowded, unprofitable tech names during the year as well. But it did say its biggest detractor performance was index-linked gilts. Of course, you'd find these in many capital preservation trusts. But if you look at those longer term performance figures, 3 years and 5 years, they have included, choppy periods, but yet those are quite commendable return figures from these trusts. So I think investors are asking, is this just a blip? Was it just a bad year because of the bonds? Or is there something changed? And I think if you asked any of the managers of these capital preservation trusts, they would say, a bit of patience, bonds was just a very, very unusual year, and fingers crossed we're going to be working right going forward. And just one quick sort of illustration of a point I made earlier, how 2022 saw a real shift away from growth into value stocks. But just look at what's been happening recently. The last 3 months, the All Country World MSCI Growth Index is up 9%. But the value index is down 2%. So we have seen this year a real shift in style once again. So the big question now is what happens next? So I think the first thing we need to address is the banking sector. Yes, we've had some of these banks rescued or broken up, but that doesn't mean to say the problems are over. Now, over the last day or two, we've had some updates from US banks. We've had names like Charles Schwab, State Street, M&T. They're all saying that they've seen a big outflow of deposits. People are switching money to other places. And so this can be problematic, particularly for smaller banks that rely on having all these deposits there. And what they're doing is that investors are either moving to another bank or they're moving money into money market funds or US government bonds. They're looking for that big, better return. And I wonder, what happens next? One thing is definitely going to happen, it's already in motion, is we have a bit of a fight to get the best rates for deposits. You've had names like Apple say it's going to launch a market-leading rate in conjunction with Goldman Sachs. And of course, they're trying to lure lots of people in, but those banks that aren't able to compete, could struggle here. But also, actually, if you're going to push up your rates on deposit accounts, actually what you're doing is potentially giving up some of your profit margins here. Now, the next thing is that banks are looking at this latest crisis and thinking, maybe we should be a bit stricter on who we lend money to. So if we have less loan activity, having to pay higher rates on deposits, it does sort of put a question mark over sort of the outlook for banking sector earnings. And of course, if banks are lending less money to people, does that sort of have the trickle-on effect to sort of have a negative impact on the economy? So you can see you've got all these sort of issues here that sort of think, what's going on? And the other thing I would sort of point to is that whilst the equity market seems to be quite resilient, bullish even about what's going on, just look at the bond market. We've got it inverted yield curve, and normally what this means is you've got high rates on shorter duration debt versus longer duration. And normally what would happen is the longer duration product you have, you should see a higher rate in the future, because it's to compensate you for the risk of holding that debt for a longer period. But what happens when you see the reverse of it? It tends to be a red flag. People see this as an indication, as we've seen in history, of a recession. The New York Fed has a recession model on its website, and at the moment it's showing the highest probability for a US recession since the early 1980s. So if you have an inverted yield curve, potentially stricter lending criteria, potential downgrade to earnings forecasts, a tight labor force, high inflation, the more of these factors that we see, the gloomier the outlook for global equities. If we see falling inflation, you might think that's good, but actually that's a sort of, particularly falling inflation for goods is a sign of, waning demand. Now, inflation has been holding up revenue growth for lots of companies over the last year. So inflation starts to ease back, and we see disappointing revenue growth for companies. They've already had margins squeezed by higher costs. If revenue disappoints, what's going to happen in margins again? And I just think that that could be a catalyst for investors to sort of think twice about what's going on with equities. So potentially we've had a great start to the year, but there are lots of clouds gathering here. Of course, if you're a long-term investor and you're happy to sit tight, keep feeding money into the markets, perhaps on a monthly basis, this is no different than we've seen lots of times before. It's tricky trying to time the markets, and I think long-term investing could be a sensible strategy to take, but just be aware of some of these headwinds that are coming. Now, in this sort of situation, if we do have a gloomier time, one might think that quality characteristic companies with high profit margins, pricing power, might be the ones that could be back in favor, and defensive once again. So I think if you look back at periods of where there's been an economic slowdown, names like or sectors like food, beverage, grocery, household goods, these are the ones that have sort of stood up a bit better. But